another group, so I cannot remember which one that we stopped last time. Up to which one? AJ or others? Others? Which part that we stopped last time? Stage by stage, done or not yet? Okay, 25, boy. Thank you for 25. Okay, try to look at 25 here. Hopefully that we're able to finish by today, the slide. And then for your tutorial, we need to extend because we need to discuss the example so that you can prepare for the tutorial. So you're going to extend your tutorial up to Wednesday. Yeah? Okay, submissions of tutorial will be on Wednesday. Yeah? Wednesday. Okay, slide 25. 25, 25, 25. 55 done already. What? Done already. Oh, we have done for the proportionate. Huh? Okay, so okay, so we're going to look at here. 25 done. 24, 25 done. Okay. So, okay, you have two methods. Just repeat a little bit only. Okay, we have two methods to account or to prepare a consolidated financial statement when we have more than one subsidiary. So we are using the one step, the other one. We have two methods. Okay, can I put it here? Two methods here. We're going to have the first one is step by step. Okay, step by step. And the other one is one stage method. We're going to learn that today about one stage method. Okay, for step by step here, we should start with a lower tier. So lower tier means that let's say you have a parent have a subsidiary one, and then the subsidiary have another subsidiary. So we start with prepare a consolidated financial statement for subsidiary one and subsidiary two. Prepare one consolidated financial statement. After that, you're going to prepare a consolidated financial statement between parent and subgroup. So you're going to have the second consolidated financial statement. Okay, so this one is step by step. Yeah. So for step by step, we have two methods. Okay, we need to look at whether the NCI is measured at fair value or NCI is measured at the proportionate shares. Okay, the difference here, not proportionate shares, the proportionate net assets. Okay, once we use a proportionate net asset, we need to have an extra adjustments here. Okay, extra adjustments here. We need to exclude. Okay, exclude the goodwill for NCI. Goodwill for NCI. Okay, so goodwill for NCI is calculated based on a direct percentage of NCI times with the amount of goodwill. Even though you put the word indirect, but suppose that direct, yeah. So this is the term using by the standards. Yeah? We need to exclude the indirect, the goodwill into indirect goodwill. But how to calculate that this indirect NCI here is a direct NCI time with the amount of goodwill. So this is the additional adjustment that we need to do when we use a proportionate net asset method. Yeah? Okay. The second method that we use here is okay, so we're going to use fair value method NCI, which is measure at fair value method. So this chatbot is a little bit. Okay, so we're going to look at the second method. The second method is NCI at fair value. So this one is already A, B, and B here is the journal entry. C here is for the exclude of goodwill. Yeah? So you need to check A, B, C, D. ABC is referred back to the journal entry. Okay, now we're going to look at the NCI is measured at fair value. So for NCI measured at the fair value at the respective acquisition date, consideration paid by parent are based on the fair value of a subsidiary as a whole. Okay, you need to calculate the fair value of subsidiary as a whole so that the fair value of the NCI is calculated. For these examples here, if you look at here, now we're going to calculate the fair value of subsidiary as a whole. How we're going to calculate this one is based on the COI by parents, okay, by parents, divide by percentage of parents. Okay, COI by parents here is 3 millions. Okay, divide by percentage of shares that I have here is 60%. So the fair value of the company of B as a whole, as a whole here is 5 million. Okay, from this 5 million, then you can find for the NCI. So NCI here has 40%. So 40%. Okay, the first step, find the fair value, and then the second step, find the value of the NCI. Yeah? So the NCI here will be 40% time with 5. Here, 5 here is a value of B as a whole. So we're going to have here is 2 million. So 2 millions altogether. Okay, and then for CC, to find the fair value of CC here. Okay, in CC here, the parents in, okay, we have a parents that we have here, A, B, and C. So A is ultimate parent, B is intermediate parent, and then C is a subsidiary. Okay, A have 60% in B, and then B have 75% in C. So to find the value of C here, you need to look at how much B invest in C. So the amount here is 2.7 divided by 0.75. So you're going to have the fair value here will be 3.6. Okay, this is the fair value as a whole. So to find for the NCI here, 25% here, because parent has 75, so NCI have another 25. So 25 times with 3.6, so you're going to have 0.9. So that 0.9 here is the value of the NCI. Okay, so this is important. Please make sure that you know how to prepare this one. We're going to calculate the goodwill, because once the NCI is measured at a fair value, then we're going to have a goodwill for both parent and NCI. Yeah? Okay, so the company for, look at for B first. The company here in a B, B implied value here is 5 million. I would find this one is 3 divided by 0.6, 3 million. So we're going to have 5 million. Net identifiable assets here is 3 millions. Where to get that 3 millions here? It's a 3 millions here is from the shares capitals of 2 millions, and then another 1 millions here is a reserve that you have here, revaluation reserve. Yes, so we're going to have 3 million. So the goodwill here will be 2 million. So 2 millions here we're going to allocate between parent and NCI. Forget to unmute the entry. Yeah? Okay. Hopefully that won't disturb much. Okay, so we're going to have here 2 million times with the parents. Parent has 60%, so we're going to have 1.2, and then NCI have another 40% here. So the amount goodwill for NCI here will be 800. Okay, for B and C here, the value company implied value here is 3.6, which is 2.7 divided by 0.75. Yeah, 3.6 net asset that you have here is 2.5 from shares capitals 1, and then reserve we have 1.5. Yeah, 2.5. So the goodwill that we have here is 1.1. So 1.1, 75% for parents, and then another 25% to the NCI. So for parents 825, and then for the NCI here 275. Yeah, so this is what we have. Okay, now prepare the consolidated journal entry, consolidated journal entry. So for consolidated journal entry, we should start with a lower tier. So lower tier means that PB and CC. Okay, PB and CC. Lower tier. Start with this one first. Okay. So we're going to have here, so BB in CC, BB has 75% in CC. So 75% time shares capital. Okay, reserve also the same thing, and then goodwill 8 to 5 from the calculations that you have here, 8 to 5 for the goodwills. Okay, and then we're going to have here investment 2.7. Okay, and then this one is for the NCI. NCI shares capital 25%. Okay, in CC 25%. Shares capital 25% time with 2 million. Is it 2 million here or 1 million? So that should be the same. To realize this one, the shares capital start. Okay. So okay with that one. So 1 million, not 2 million here. So you're going to have 1 million for shares capital. So okay, so going to have that one slide 28 that we have here. Okay, and then reserve 1.5. Okay, we're going to 375, and then goodwill on consolidations here. So your goodwill from consolidations here is from slide 27. Yeah, so portion for the NCI here is 375 here. So this is a second journal entry, and then credit NCI at the segments of financial positions. Okay. So the next one, we're going to have here the consolidated here. So consolidated here, we start with the lower tier, so B and C. Yeah? So B and C, A, B here is the journal entry. So you refer back to the journal entries here, which one that you need to debit, adjustment, and then which one that you need to credit. So I just want to skip this one. Hopefully that you know where this figure come from to make an adjustment. Yeah? Okay, so the reserve at the end, your shares capital is 2, reserve here is 1, and the NCI of 900. 900 is journal entry B. Yeah? Investments here, we need to eliminate in journal entry A, and then goodwill here, or the amount of goodwill here is 1.1. 1.1 here, need to allocate to parent 825, and then to the NCI 275. Yeah, 1 to 1. So you're going to have this one. Okay, so this is your first consolidated financial segments of financial position. So we're going to use this information. Okay, this is your first concept financial statement. We're going to use this information to combine between A and B. So we already have B and C, and then the next step we're going to combine between B and A and B. So we're going to use this information for a combination. So we're going to do the same thing for A and B. A and B. So for A and B, investment A have 60%. So 60% time with 2 million here. Okay, and the reserve 1 million. And then goodwill here is 1.2. 1.2 here is from slide 27. Yeah. Okay, and then we're going to have investments here is 3. And then for the NCI here, NCI 40% time with 2, reserve 1, goodwill and consolidation here is 800, and then NCI here is 2 million. So this is what you have between A and B. Yeah? A and B. Okay, now look at this one. The term that I'm using here is a subgroup. So subgroup here is come from. These informations come from slide. Can you refer back to slide 23? Okay. So this come from here, subgroups here. Okay, we're going to use this information to combine with A. So combine this information with A. Combine this one with A. So we are using a subgroup. Subgroup here is between B and C from the first consolidated financial statement. Now we're going to combine with A. AB here is from the journal entry. So at the end, we're going to combine these two, add these two figure, and then minus this, and then we're going to have 4. The same thing with the reserve, add this, and then minus this figure. So we're going to have 2. NCI here is 900. 900 plus another 2 from journal entry B from the NCI portion. Now the value of NCI become 2.9. Investments here will be 0. Okay, goodwill here is come from parents and also for the NCI. So you're going to have 3.1. Yeah? Okay, this one is already exists a goodwill between B and C. So you have that goodwill plus another 2 from B in B. So we're going to have parents like 1.2 and C I have 0.8. So altogether your goodwill here will be 3.1. Combination between A and B is 2, and then plus C. C another one is 1.1. Yeah? Okay, so altogether you're going to have 3.1. Except just total up that two figures. Yeah? Okay. So that is what you have for the NCI measure at fair value. If you look at here, if you look at the NCI measure at fair value, we don't need to make any adjustment. Like a normal consolidated financial statement, except that you need to do step by step. Step by step here, we're going to start with a lower tier. From that lower tier, prepare the journal entry and then also prepare a consolidated financial statement. Okay, the information from consolidated financial statement from the lower tier is used to combine with the ultimate parents, with the main parents that we have here. Okay, so we have done with the step by step. Okay, so now we're going to move to one stage method. Yeah. Okay, any question for this one? Okay, now we're going to proceed with the next one. Yeah? So the next one is one stage method. So one stage method here is another method that we use to account for the when we have more than one subsidiary. For this one stage method here, you're going to prepare a consolidated adjustment are made by the reference to the ultimate parents. Means that ultimate parents going to use its effective indirect interest in the indirect subsidiary. So we're going to this step by one stage method is a shortcut method. Yeah? So we're going to prepare once on consideration journal entry, but this time we are using the effective interest, indirect interest by ultimate parents in the indirect subsidiary. Additional adjustment that we need to do here is in matching the cost of investment with the ultimate parent effective shares of net asset in an indirect subsidiary. The portion of cost attributable to the NCI in the immediate parent is going to be excluded and charged to the NCI account a portion of cost attribute to NCI. So this one, let's say you are going to have one subsidiary. So subsidiary A, the parents here is ultimate parent, and then you're going to have B. B is intermediate parents, and then we're going to have C here is the subsidiaries. Yeah, subsidiaries. So once you're going to use a one stage method here, you're going to account using indirect interest. Okay, indirect interest. So for indirect interest here, the portion of NCI, okay, portions of NCI, okay, in immediate parent need to be excluded. You need to exclude. How are we going to exclude this one? Is the percentage of the NCI times with the COI by immediate parents. By B. Yeah? In this case here is by B. Yeah? This inclusion is necessary if the way is to reflect only the ultimate parent proportionate shares. We need to use this method because we want to adjust for the bills. Okay, maybe you not understand yet. We're going to look at the examples here. Okay, so now we're going to look at this example. So we're going to account. See, we are using one stage method. So we're going to account for the indirect interest. We're going to look at the indirect interest. Focus on the indirect interest of ultimate parents. Okay, A acquired 60% in B on 31st December when the net asset was 3 million. So A acquired B. Okay, acquired B. The net asset of B was 3 million. Yeah? And then percentage here is 60%. Yeah? Okay, on the same day, B acquired C. Okay, another 75% here acquired C. The net assets here is 2.5 million. Yeah? Okay, so this is what you have. Okay, 60%. So indirectly, you're going to have here, indirectly, A can control C. Okay, A control C through B. Okay, so I mean, okay, and then A going to have indirect interest in C. Indirectly, we have here 60% times with 0.75. Yeah? They're going to have indirect interest of 45%. Yeah? Okay. So we're going to use the same examples here. So this is what we have. Shares capital is 2 here, 1 here, and then reserve. So if you look at here, the net assets here is 2.5. This one is 3 here, already given here. Okay, and then investments here is at the value of 3. And then this one is at the value of 2.7. And let's say that at the respective acquisition date, the consideration paid by the parents are based on the fair value of subsidiary as a whole. So investment in the value of B as a whole is equal to 3 divided by 0.6, which is 5 million. Okay, and then the value of C here is 2.7 divided by how many percent that we have? B in C, B investment B in C here is 75%, isn't it? Okay, 75%. Okay, 2.7 divided by 75%. So you're going to have here is equals to 3.6. Yeah? So this is the value of B and C as a whole, as a company. Yeah? Okay. We need to use this information later. So we assume the NCI is measured using proportionate and the NCI at fair value. So now we're going to prepare the journal entry using consolidated journal entry and adjustment using one stage method. So one stage method focus on the indirect interest. Okay, so this is what you have, structures that we have here. Okay, parent has 60 in B, and that means that NCI have another 40%. Indirectly, parents have in C is 45 to this one, 45%. Okay, and then NCI here. If you look at here, NCI here going to have 40% in B, and then NCI in C is 25%. So indirectly, NCI going to have shares in C through B is 40 times with 75. Yes, so we're going to have 30%. So altogether, direct NCI here is 25% plus 30. So NCI have another 55%. Okay, make sure that when you calculate here, this one should totals 100%. Yeah. Okay, so indirect, parents have 45. And then for the NCI, we're going to have another 55. Yeah? Okay, direct and indirect. Okay, and then we're going to account using NCI at the proportionate shares, net asset of shares of net asset. So means that there is no goodwill for the NCI here. So the cost of investment is 3 million. NIA here for the parents here, we just only calculate for the parents. Sorry, going to calculate for the NCI here. So NCI, parents have 60%, so NCI have 40%. We're going to have here is 1.2. So altogether, total investments here will be 4.2 minus 3 here. So we're going to have 1.2 for the goodwill. So goodwill here, we're going to have goodwill in B here is 1.2. Yeah? Okay, and B and C here, okay, the value here is 2.7. NIA here 25, NCI here 25% time with NIA 2.5. So you're going to have 625. So the totals that you have here is 3325. Yeah, 3325 minus 2.5. So you're going to have 825. 825 here is a goodwill that we have in C. Yeah, in this one. Yeah, so that is a goodwill that we have. Okay. Now the journal entries here. The first journal entry, we're going to provide journal entry combinations of A and B here. A and B here. So A has 60% in B. So A 60% times with 2. 2 million here is a shares capital. And then 1 million is for a revaluation reserve. And then we're going to have a goodwill of 1.2. So parents, you still have a goodwill. All that 1.2 is to parents, their credit investment. Okay, shares capital for NCI here 40%. So 800 reserve 40%, 400 NCI is 1.2. So it's like the same one that you have here. Okay, A and B is a direct. A to B here is a direct interest. Just a normal one. Direct interest means that the way that you account is the same. Prepare the journal entry is like the previous one. Okay, and then the second one here is between A to C here. Okay, A to C here is a indirect interest. Indirect. So indirect interest here, A have 45% through B 60 times 30, 75% previously through B. Okay. So indirectly, ultimate parent have 45% interest in C. So the shares capital in C is 45%, 45% also for reserve. Goodwill here. Okay, we look at this one. Okay, now we're going to look at this one, the NCI here. So the NCI here, we said that we need to exclude the COI, NCI, COI, based on parent intermediate parent. IP is intermediate parent, COI. So NCI portion here is 40%. So 40% times with 2.7. Yeah, 40% here is a share in immediate parents. Yeah. Okay. So how to find this one? NCI percentage in immediate parent time with the immediate parent COI. So immediate parent COI here is 2.7. Yeah. So we're going to have 1080. And then goodwill on consolidations here is 60% time with 8 to 5. 8 to 5, 60% here is a portions of A in B. So A only entitled 60% of B goodwill. B goodwill. So B goodwill in C here is 8 to 5. Yeah, so A only entitled 60% through B here. So that's why we're going to have 60% times with 8 to 5. Yeah, so we're going to have 495. And then credit investment 2.7. Yeah. Okay, for the NCI, so since parents have indirect interest of 45%, so means that NCI have another 55%. Yeah? Okay, so shares capital, reserve, and then the NCI. Yeah? Okay, any questions that you have for these examples here? NCI at the proportionate shares. Okay, so we proceed with the next one. We prepare the consolidated here. A, B, C, D. Here is referred to the journal entries that we have here. Yeah? Okay, so shares capitals here is this one is in B, this one in C, this one is in B, this one is in C. NCI 1080 here, 1080 to get this one is journal entry C. Journal entry C 1080 here is to exclude the NCI. Yeah? So that's why we have to debit, debit, and then credit here 1.2 here is journal entry B, and this one is D, journal entry D. So total up, we're going to have NCI 14995 here. Okay, the investments here will be 0 here, and then the goodwill here 1.2. 1.2 is goodwill in B, and then 495 here is a goodwill parent portion. Okay, parent portion in C through B. Okay, 495. Yeah? So 1695. Okay, so any questions that we have here? Any of you have a question? So please, for the adjustment, I'm not going to discuss detail. You refer back to the journal entry that we have there because we are quite rushing for this chapter. So we proceed. We proceed. If you have a question after this, we proceed with the next one. When the NCI is measured at fair value. So we need to calculate a goodwill here. So the goodwill here, we already calculate for the value. So the value here is 3 divided by 0.6. So the company total value here, value as a whole here will be 5 here. Okay, net asset, the shares capital here is 2, and then the reserve, what you have here, reserve, isn't it? Reserve here is 1, yeah. So you're going to have 3. So goodwill that you have here is 2. From these 2, you need to allocate to parents 60, and then to NCI 40%. So 1.2 for parents, and then 800 for NCI. Yeah? So this one is in B. Yeah? In B. Okay, in C here, value of the company of C here is 2.7 divided by 0.75. Yeah? So you're going to have 3.6, and then asset shares capital 1. 1.5 here is a reserve, so we're going to have 2.5, so goodwill will be 1.1. 1.1 here, 75% to parents, another 25% to the NCI. So we have 8 to 5 and then 275 here. Okay, so now going to look at the journal entries here. So journal entries is the same like the proportionate shares, except not proportionate net asset, except for this one. Yeah. Okay, this time we're going to have a goodwill for the NCI. Yeah? Shares capital is the same, reserves also the same, goodwill also the same for the parents here. Okay. So we're going to have this one A, this one is a B. Sorry, A, B. Later on you're going to look at for the adjustment. Yeah? The same here except for this one, except for going to have a goodwill for the NCI. Yeah? Okay, now look at A and C. A and C, we are using the indirect interest, indirect interest of 45%. So you're going to have the same journal entry for parents, okay, like the one that you have for the proportionate net asset. Goodwill here, the amount of goodwill here is only 45% of the NCI time with 1.1, 1.1. So you're going to have 495. NCI here is NCI in B, 40% time with COI of B. NCI percentage in B time with COI. Okay, so go to 2.7. Yeah? So the goodwill sale only, parents only entitled 45% based on their indirect interest. Okay, and then okay, for the NCI, so NCI going to have 55%. Yeah? So 55% time with a shares capital, reserve, and also a goodwill 55% because parents only entitled for 45% based on their indirect interest. So the go NCI here will be 1980. Okay, so this is journal entry C and D. Yeah? Okay, so proceed with this one, the adjustments that we have here. So the adjustments here, A, B, C here is referred to the journal entry previous one. So this is journal entry in B. This one is for C. This one is B. This one is a C. This one is for the eliminations that you have journal entry C. So eliminations of the or exclude NCI to exclude NCI. 2 here is for the NCI that we have for the B. And then 1980 here is in C. Okay. Investments we need to eliminate. So goodwill here is by parents here. Ultimate parents A. This one is in B. And then this one is a portion in C. 605. What do you have for 605 here? 605 here is the NCI goodwill. So at the end we have 5.8. So any questions that you have for this one was one stage method. So for one stage method, we go into account for the ultimate parents using the indirect interest. So one thing that you need to remember is here, when you use a one stage, okay, one stage here, okay, ultimate parents, okay, need to use the indirect interest. Okay, and then for the NCI here, we need to exclude NCI in immediate parents. Yeah, immediate parent. So how I'm going to calculate that one? The percentage in immediate parent time with the immediate parent COI. Okay, so that is what we have it. But most of the time we are using the one stage method, yeah, because that one is a shortcut method. Step by step method is a bit difficult when you have more subsidiaries or what a subsidiaries. Yeah? So we need to start with a lower tier, repeat the same step until we reach to the ultimate parents. Yeah? The one stage method here is a simple, but we need to use, we have to remember these two things. Yeah? Okay, the ultimate parents going to account using the indirect interest, and then the NCI here need to exclude NCI in the ultimate parent, in the intermediate parents. Yeah, have to find the NCI in the intermediate parent, percentage in intermediate parent time with intermediate parent time with intermediate parent COI. Yeah? Okay, so remember this one. Yeah? Okay. So we move to the next one, or do you have any question before we move to the next one? Any of you have a question here? Okay, we proceed, huh? Lisa, if you have a question, yeah? So we're going to proceed. This statement is a little bit confusing. Later on, when you look at the diagrams here, it's easy. This one is to find when is the effective acquisition date of the indirect subsidiary. Okay, when our ultimate parent company acquire a direct subsidiary, which itself owns a subsidiary on the earlier date, the effective acquisition date of the indirect subsidiary as regard the ultimate parent is the date in which is acquired the direct subsidiary. A little bit confusing. Later you look at the tables, you understand. Okay, but if the indirect subsidiaries was acquired on the date later than the acquisition date of the direct subsidiary by the ultimate parent, the latter date is the effective dates of the acquisitions of the indirect subsidiary as regard to the ultimate parents. Okay, quite confusing, but look at this one. Okay, we're going to determine when is the acquisition date, the effective acquisition date. Okay, we look at the first one, the situation one. Okay, we have ultimate parents here. So these parents, okay, acquired M on 1st of January 2018. Assume that this one is 2018. Parent acquired M in the year 2018. When parent acquired M in the year 2018, M is already have the N as a subsidiary in the year 2015. So we assume that, okay, once parents P acquire M in the year 2018, but M already have N as a subsidiary, so the indirect interest between parents to N here is considered at the date when, okay, P to N here is considered the date when parents acquired M, the date on 1st of January 18. So this is considered as the acquisition date. So indirect interest of parents start from, okay, indirect interest of parent in N here is considered on 1st of January 2018 at the date when parents acquire a direct subsidiary of N. Even though N is already have M is already have a subsidiary in N in the year 2015, but the acquisition date is considered when the parents have a direct subsidiary in January 2018. So this is the first situation. Yeah. The second situation here, parents acquired M on 1st of January X5. Okay, acquire M. And then later, okay, during this time, M do not have a subsidiary in N yet. Later, M acquire N in January X7. So it means that parents only have an indirect interest starting from 1st January 2017. Okay, so before this, okay, parents acquire M, but during that time there is no N yet. Okay, and then after that in the year 2017, M acquired N. So parent is considered to have indirect interest in N. Okay, in N starting from 1st of January at 7. Okay, so this is what I mean by number 1 and number 2 in slide 45. Yeah, so this one is more, you can understand from this one as compared to the statements given there. So this is what we want to determine when is the effective acquisition date. So it's dependent. Okay, for this one, parents acquires direct subsidiary later. Then the subsidiary have the indirect subsidiaries. But this one, parents acquired subsidiary during that time, there is no indirect subsidiary. And then after that, this direct subsidiary bought another subsidiary, so it's considered at the date when the direct subsidiary bought an indirect subsidiary. So, okay, so that is what we have here. This is about the dates only, when will be the acquisition date. Okay. So now we're going to look at the changes in state. Change in state. That is another thing. Okay, we have direct and indirect interest with a change in state. So example that we have here, P has a shares in A of 80%. Okay, and then A also have a shares in B for 60%. So if you look at here, indirectly, P Okay, indirect. Okay, B acquired A 80% and then A acquired B another 60%. So indirectly, P has a control over B through A over here, through here. So going to have here indirectly, they're going to have about 48%. Yeah? This one is on 1st of January 2015. So the acquisition date was in the year 2015. But later in the year 2019, P bought another 15 shares in B. Yeah? So P bought another 15 shares in B in the year 2019. So this subsequent purchase of shares in B by P shall be treated as the equity transaction. So we're going to account it using the equity transactions, because you bought here is on, you already have a control and then you add some more shares. So it's referred back to your part one, notes of your part one, when you acquire additional shares. Okay, so if you look at here, the NCI has 20% here. And then in this, NCI has 60 plus 15. So you're going to have 75. So NCI have another 25%. Okay, so this is what you have. Yeah? Okay, we try to look at this example. Example 3. Okay, X acquired Y 75%. Okay, for cash considerations here is 52.5 million. Yeah? On the date, the return profit was 18 million. RE was 18 million. Yeah? Okay. And then it said that, and on the same day, Y acquired Z. Okay, Y acquired Z 60%. Okay, acquired Z 60%. For cash considerations here is 23.4. 23.4. Return profit was 11. Yeah? Okay, on 1st of January 2019, X acquired 20% interest in Z. Okay, acquired another 20% in Z. So this one is a direct, yeah? Direct 20% in Z on 1st of January 2019 for the 0.08. Yeah? So this one you have for the investment. Yeah? So you need to know the diagram. Yeah? When you answer these kinds of questions, please show the diagram. So it will help you. Okay, these diagrams. Okay, the shares capitals in Y here is 40. So you remember that previously the RE here is 18. Yeah? So you're going to have the total net identifiable assets here will be 58. Okay, and then for Z here, shares capitals 20. RE was 11. So you're going to have here at the acquisitions date, the net assets here is 31. Please remember this figure. We're going to use this one later. Okay, so this is what you have. The RE, it seems that the RE has been increased. This will also be increased. And then you're going to have investments here. This investment here, you're going to have here the amount of investments here is 52.5 here. That 52.5 here is 75%. Yeah, 75% you acquired. And then this 23.4 here is 60%. Okay, 8.08 here is for the additional 20%. Yeah? Okay. In Y. Sorry, inside. Yeah? Okay, so this is a profit. Profit for X and for Y, for Z, and then RE. So be careful with this figure. We're going to use later. RE carry forwards, brought forwards. Okay, and then said that at the respective acquisition date, the consideration paid by the parents are based on the fair value of the subsidiary as a whole. So for Y here, Y you paid 52.5 divided by 0.75. Okay, and then we have to find the value as a whole, value of the company as a whole. For the Z here, the investments here is 23.4, isn't it? Okay, 23.4. This one is divided by 0.6. We want to find the value here, the value of the company. Okay, so what you have for the value of the company here? So this one will be 70 million. Okay, and then for this one will be 39 million. Yeah? So we need to find the value as whole. And then the NCI is measured at fair value. Yeah? So means that we're going to have a goodwill for both parent and NCI. Yeah? Okay. So the question need to prepare the consolidated financial positions. Okay, so this is what you have here. So you have here. Okay, so you have 75%. And then this one direct here is the one that you have additionals, and then you have 80% here. Okay, so directly X in Y 75%. Okay, and then inside they have a 20%, which is the additional. Okay, indirectly through Y, through Y. Okay, this one is indirect. So through Y here is 75% times with 60. So you're going to have another 45%. So altogether, parent shares in Z here will be 65%. Yeah. So 20 direct, another 45 is indirect. Okay, for the NCI. Okay, NCI in Y here is 25% because parent have 75%, so 25%. And then in Z directly, NCI have 100 minus 60 minus 20. So I have another 20%. Yeah? So indirectly through Y here, this 25% times with 60. Yeah? So this is what you have. So you're going to have 15. So altogether, for the NCI, going to have about 35%. So make sure that when you total up, this figure should equals to 100%. So make sure that. Okay. So this is a diagram. So next time when you answer this kind of question, please prepare this kinds of diagram. It will help you much. So we proceed. If you have any question, please. You proceed. You just voice out. Maybe I missed some of the one that you put it in the chat box. Okay, so we need to calculate the goodwill for consideration. So the goodwill here, we already calculate the company value 70. And then net asset here, the shares capital is 80. And then RE here is 18. So we're going to have 58. So goodwill 12. From 12 here, 75% to parent and then 25% to the NCI. Yeah? So we're going to have 9 and 3 here. You just prepare like this one. Yeah? Calculate for the value of net asset and then find the goodwill there. Okay, for Z here, company value is 23.4 divided by 0.6. 23.4 divided by 0.6. Okay, so you're going to have 39. Asset shares capital 20, RE here is 11, so you have 31. So goodwill 8, 860 to parents, and then 40 to the NCI. So you're going to have that amount. So okay, proceed now. So prepare this one, we're going to look at the changes in stake. Changes in stake here is a movement in the equity. Changes in stake here when a parents here, what? Okay, parents here is X, bought additional shares in Z, Z of 20%, 20%. So parents is already control Z. They already control Z through Y. So once they bought an additional share is considered as a changes in stake. We're going to account for a movement in equity because you already have a control indirectly. You already have a control in Z through Y. So once you bought a new shares here, it's considered as a movement in equity only. So you need to refer back to your slide in part 1 in the movement of the equity. So the first thing that we need to do here is to find the value of the NCI. Yeah? So the value of the NCI here is based on slide, refer back to slide 52. So 52 here, if you refer back to the value of 52, slide 52 here, this is the one here. The company value. The company value here was 15.6. So that one is the cost of the value of the company. So you're going to have the value for the NCI here is 15,600. So 15,600 is the NCI on 1st of January 2018. So in that NCI, we need to add the amount of shares of profit. Shares of profit 15,400 here is from your RE brought forward. Yeah? So RE brought forward minus the RE at acquisitions. Yeah? And to find the portions of the changes in post-acquisition profit. Yeah? So you're going to have here and then time with 40%. So during this time, the NCI here. If you look at here, Y in Z here is 60%. So means that NCI have 40%. So time with 40%. So you're going to have here 1760. So total up these two figures and then you find the carrying amount on 1st of January 2019. The 1st of January 2019 here is at the date when you add new additional shares, 20%. So you're going to have the value here will be 17,360. So 17,360 here is the carrying amount. So the carrying amount that transfer to the parents, from that 40% you transfer to parent 20%. So 20, this one 20 divided by 40 times with 17,300. So you're going to have here the CA here is 8680. From the CA, the parents only pay 8080. Where to get this one? 8080 here is refer to the information given. In slide 49, you also can find that one. In slide 48 also, it said that they acquire additional 20% interest in the equity for considerations of 8080. So this is the amount paid by considerations transfer or paid by parents. So if you look at here, the carrying amount is higher than the consideration received. Consideration received, so means that when the carrying amount is higher than consideration received, means that parent paid less. So when parent paid less here, parent paid less, lower than the CA, so they're going to have some sort of a gain, but we don't recognize that gain, so we're going to record it as a positive movement in the equity, means that you're going to credit your RE letter. Okay, so because parent paid less than the carrying amount, let's say parent paid 9 million, so it means that you're going to have a negative movement because you paid more than the carrying amount. In this case, you paid less than the carrying amount, so you're going to have a positive movement. Okay. So the journal entries here, we start with X and Y. X and Y first. Okay, so X and Y, shares capital 75% time with 40. And then the return profit here is 17% time with 18. So for parent here should be at the acquisition date. So the goodwill for parent is 9. For investments here will be 52,500. Okay, this one is for the NCI. NCI have only 25%. So time with 40. RE also 24,600 here is RE brought forward. For NCI, we are using RE brought forward. And then goodwill sale will be 3 for the NCI. So credit the NCI as a segment of financial position. So because NCI using a fair value method. So, okay. Now X and Y. So now we're going to look at the next one is the shares of profit for the year. Shares of profit for the year, 25% time with 8,400. 8,500 is referred to slide 50. So if we said that profit for the year, okay, for in Y, 8.4. So you're going to have 2.1. Okay, credit the segments of financial position. Okay, done with X and Y. Okay, now we're going to look at the Z. Okay, so inside here, okay, inside, going to have here, okay, we are going to have X and Z. So X and Z here, okay, at the beginning, X have a indirect interest. So indirect interest of 45%. Yeah? So 45% here, shares capital 45, 45 here. Goodwill also 45%, and the investment 23,400. Okay, this one. This one you have to be careful. Yeah, this one you need to exclude the NCI. Okay, exclude NCI. To exclude the NCI here is a percentage of NCI in immediate parents. So immediate parents here is Y. So percentage that you have in Y here is 25%. Time with investment or COI of Y inside. So COI that we have here is 23,400. Okay, so be careful with this one. Okay, and then we have investments here, 33,400. Only this one, the percentage here, the difference here is this one, yeah, because NCI here using this NCI in immediate parents, yeah. Okay, and then for the NCI, shares of capitals here, 55. Return profit is also 55. Goodwill also 55 here. Why you have 55 here? Because parents have a 45%. So NCI have another 55%. Yeah? Okay. Yeah, that is the journal entry. And then the last journal entries that we have here is to record for a positive movement. So positive movement, one that you need to credit here is the investment in Z at cost or at carrying amount. So return profit brought forward here is the positive movement. Positive movement here is credit side, yeah. Movement. And then NCI SP, sorry, not this one. Investment inside here is at consideration that paid, the one that you paid here. And then NCI in the segments of financial position here is at CE, carry amount. Yeah. So you need to debit here because you want to reduce the NCI here. Should debit at carrying amount. Return profit here is a positive movement. Investment here is how much parent paid. Parent paid is 8080. This one is to record for changes in state for a positive movement. Yeah? Okay, and then the last journal entry that we have here is to record for the shares of profit. Okay, shares of profit inside. Okay, shares of profit inside here. NCI has 35%. 35% time with 5,600. Where do you get this 35% here? Refer to slide 51. Yeah? Okay, 51. Okay, parent have a 65% shares, and then these parents 65% have a combinations of direct 20% and then indirect 45%. 45% for indirect, so 65. So means that NCI have another 35%. Okay. So any questions that you have for this one? For the additional state that you have changes in additional state. Okay, so we look at, okay, just finish with your statements here. Okay, so this is your consolidated adjustment. Okay, for consolidated adjustments here, you have profit. Profit, just add 3 company together. Just add. Okay, plus, and then we have this figure. NCI here, CNG. CNG here is 2.1. For the NCI, we'll look at this 2.1. 2.1 here is the shares of profit. Okay, shares of profit in Y. 1964 is a share profit in Z. Shares of profit. So from that 28, we need to minus 4. So attributable to the owners here will be 23,940. This is for portions for X. Okay, return profit, add together 3 here, plus this 3 company, minus, okay, minus 13,500 here is for Y. This one is for parents, Y, and then this one is 6150 here is for the NCI. So you're going to have the one for the NCI. Okay, and then you're going to have 4950. Okay, 4950 here is for the Z, in Z. Okay, both on this one for parent, and then this one is for the NCI. NCI have 55%, Z only have 45%. Change in state here is a positive movement. So then you're going to have RE brought forward 7.07470. Okay, and then the statements that you have here. So this one is from the journal entry that we have here. Shares capitals. Okay, 30. Okay, 30, 40 here. This one is for the Y. And then 9 plus 11 here is for Z. Okay, return profit here is from the previous one, 107. And CI here, 5850. 5850 here is in Z. Debit in Z. This one is 86. 0.80 here is from the positive movements that we have here. The shares of, okay, positive movement. Not positive movement. The reducing in the carry amount when the NCL sold 20%, yeah, 20%. Okay, 19 here is from the journal entry B, relate with the Y. And then 2.1 here is the shares of profit. Okay, shares of profit. 23,874,87. 23,870 here is the shares in Z. Okay, and then 1960 is a profit inside, shares of profit inside. Yeah. Okay, investment we need to eliminate. Yeah, also eliminate. And then this one we also need to eliminate. Okay, at the end we're going to have 0 here. Okay, the goodwill here is this one is a goodwill in Y. Okay, and then this one is a goodwill in Z. Yeah. Okay, any questions that you have for this one? Any of you have a question, sir? Please, sir. I missed some of the thing that you have in the chat box. If you have a question, please price out the questions here. Okay. Any questions here before we proceed with the direct and indirect interest? Any of you have a questions? Is it okay with that one? Before we move to example 4. Okay, we move to example 4. The next one. Okay, this is another thing. Direct and indirect interest with a step acquisitions. Okay, so X. Okay, so look at here. Okay, X has shares in Y 60%. Okay, and also have a shares in Z 30%. Okay, X has both in Y and then in Z. Okay, this one they have 60%, so they have a controls here on 1st of January 2018. Okay, they can controls here, and then they have 30% in Z. So 30% here is a investment in associate during this time on during 1st of January 2018. Okay, letter Y. Okay, Y acquired Z 40%. So Y acquired Z 40% on 1st of January 2019. So it means that parents before this has 30% only in Z. Okay, in Z X only have 30%. Later on, when Y bought Z in the year 2019, another 40%. So indirectly, parents going to have 60 times with 40. So they're going to have another 24%. So 24%. Now the parent have a share of 54%. So parents have a control sale. So parents has a control on 1st of January 2019. Yep. Okay, this is what we have by step acquisitions. Okay, subsequent purchase of shares in Z by Y shall treated as a step acquisitions. Okay, that is what we have. Okay, trying to look at this example. X acquired 60% in Y and then 30% equity in Z. The return profit was 2 and 4 respectively. Consideration paid by X and Y based on the fair value of Y as a whole. On 1st of January 2019, Y acquired 40% interest in Z. Return profit during that date was 6, and then the fair value of Z here was 1 ringgit and 85 1 ringgit and 85 per share. Yeah? Okay, so this is what you have. Okay, so if you want to find the value of Z, okay, value of X and X value of Y. So value of Y here, you need to look at the investment that you have in Y. So investment in Y here is 7.8 or 7.8 divided by 60% to find the value here. 7,800 divided by 0.6. So you're going to have here is 13 million, yeah, 13 million. Sorry, 13 million. Okay, in Z, Okay, in Z it's already given. The fair value of Z here is 1 ringgit and 85. 1 ringgit and 85 time with the number of shares in Z. So number of shares in Z here is 10 million. So 10 million. Okay, 10 million. So this one will be 18.5 here. Okay, so this is to find the value of the company as a whole. Okay, so this is what you have. So investments, so 4.7. Okay, this one is for 30%. Yeah. Okay, this one is 60% in Y. So this one is for how many percent that you have previous before this Z in Y. Z in Y you have 40%. Okay, so that is what you have. Yeah. Okay, so now we're going to look at the profit before tax and the RE. So this is important here. The RE brought forward. Yeah. Okay, and then NCI is a measure at fair value. Okay. So this is what we have. Okay, you need to prepare this one, yeah? Okay, so we need to, so we have 60 here. 60 times with 40, so you're going to have 24. So starting from January 2019, you have a control over Z, yeah? So because you have 30 plus another 24, altogether you have 54. Okay, right here 60 plus another Y here 60, so means that NCI here is 40, and then NCI here 40 plus 30, so this NCI have going to have another 30%. Yeah? Okay. So we have here direct in Y 60, direct in Z 30%, indirectly 24, NCI direct in Y 40, direct in Z for 30, indirectly through Y here is another 16%. So altogether going to have 46. So make sure that when you total up here, it should be hundreds. Okay. Now we're going to, because it said that we need to treat a previous equity interest treated as a previous equity interest. So when we bought a new shares here, we need to remeasure the previous stake. The previous stake that you have here is 30%. Yeah? So previous stake, remeasure. Okay, previously fair value of the previous health stake here is okay. The fair value of the company as a whole here is 10 million times with 1.85. So you're going to have 18 million. So 18 million need to time with 30%. Yeah? Okay, so you're going to have here 5554. Okay, the first one is supposed to be this one time with 180 and then time with 0.3. Yeah, so we have 55. The carrying amount here, you find the COI here. COI is in your segments of financial position. It's given here is 4.7. This 4.7 is the cost of the investment for that 30% on they bought the investment was in the year 2018, 1st of January 2018. The value here is 4.7 in the segments of financial position. So this amount need to add with the post-acquisition profit. So post-acquisition profit, look at the RE brought forward. Yeah? So RE brought forward that you have here is 6 million. This one is like 62. It's like 62. Oh, sorry. What happened? Slide 62. So RE brought forward here. Minus 4 is RE at the acquisition. Time with 30%. So you're going to have 600. So altogether the carrying amount here is 5,300. Then compare with the fair value. So we're going to have a gain on remeasurements of 250. Yeah? Okay. Then you have that gain on remeasurement 250. Okay, now we calculate the value here. Okay, the fair value of the company already calculate actually this one's 13. Net asset here is 12. Okay, shares capital here is 10. And the RE here is 2. RE, so the goodwill going to have 1 here. So we're going to allocate between parents 60%, NCI 40%, 600 and 400. Okay, and then the next one for Z. So for Z here, we have two types of interest here. Y interest here 40%. Previously held here is by X here, X here, and then NCI. Three different items here. One is Y that have a direct. ZX also have a direct. That one is a previous one. And then the NCI also have 30%. Yeah? So the company value here is 18,500, 1 ringgit and 85 times with 10 million. And then from the amount here, they have 40% here. And then for the previously held 30%, the same thing for the NCI 30%. The identifiable asset here is 10, and the RE that you have here is 6. So you're going to have altogether 16. So 16 from that 16 portions for Y here will be 40%. So this amount we time with 40%. This one is time with 30%. Okay, and then this one you're going to time same thing, yeah. So we're going to have a goodwill of 2.5. Out of that 2.5 here, going to allocate to Y. Okay, Y 40%. Previously in Z, previously held by X here is another 30%, and then so the NCI also 30%. Yeah. So the goodwill allocations of goodwill that we have here. Okay, that is what I have for Z. Yeah. So please, if you have any questions, ask. I cannot see some of the things that you have in the chat box. Then. Okay, so that is what I have for parents. Okay, so the parents goodwill that we have here. Okay, parents goodwill 1 million. Okay, 1 million that we have here is times with 60%, and then plus another 750. Okay, where this one come from? Parents here, the total goodwill here is 1 million. In Z, Z goodwill 1 million. Time with 60% here is through parents control Y. Yeah? Parents control Y here is 60%. Yeah? If you look at here, 40% that parents control Y. Okay, parents control Y, X control Y here. X control Y, 60%. So when because this goodwill will receive through Y, yeah? So going to have here. Okay, Y portions that I have a for goodwill here is 1 million. So this one is a Y portions for Y goodwill of Z, which is portion for what? Okay, Z goodwill portion for Y. Okay, so Y portion here is 1 million. From that 1 million, parent have a shares in Y of 60%. So time with 60%. So you're going to have here is 600 plus another 750 from a previous shares, previous health, previous shares, previous shares 750. So altogether for parents will be 1350. For the NCI here is a difference between 2500 minus 1350. Okay, so you're going to have 1150. Okay, prepare journal entries here. So for the journal entry, so parents X in Y, you have 60%. So 60 times 10, return profit times 2. Goodwill here is 600. Where do you get that 600 here? Based on your calculations that you have here in slide 65. Refer back to slide 65. Okay. Shares capital in Y, this one is for the NCI, 40%, 40%. Then for the goodwill on consolidations here is 400. Okay. And then NCI shares of profit in Y. So profit for the years in Y here is 1,500. So profit of the year here, refer back to slide 60. Okay, the profit here is 1.5 times with 40%. So we're going to have 600. And then NCI another 600. So okay, credit financial position. Okay. And then investment here is to record for the gain on remeasurements. So gain on remeasurements here is the one that you have for the previous investment. So the previous investment inside you have 850, return profit 600, gain on measurements here is 250. Yeah? 250, return profit 600. Where does it come from? Share from a return profit. This one is referred to calculation slide 64. Okay, you have again on the return profit RE from the RE, and then this one 250 here is gain from a remeasurement. Remember that last time when we learned about disposal, okay, the disposal, we have two types of gain. The first one is gain on remeasurement. The other one is a gain on disposal. So then on disposal that we transfer to the RE and then credit investment in side. Yeah? So that is why for 600. How to calculate this one is refer to slide 64. Okay, and then for shares capitals here, so for shares capitals here, we're going to account using indirect interest. So indirect interest X in Z that we have here, okay, at in Z here we have 54%. So 54% time with 10, this one is 10 to 6. So look at here. NCI here, NCI in Y. So NCI in Y here is 40%. And then time with COI of Y. COI of Y here is 7.4. Going to have here. Could we on consolidations here, we already calculate here 1350 because the in Y, could we of Y here, we're going to have 1 million and 1 million and then time with 60% because a portion of Z in Y here is only 60%. And then plus 750 here is from the 30% interest, previous 30% interest. And then credit investment in Z. Investment in Z 7.4. Okay, 7.4 here is the amount that paid by Y. And then 550 here is the new additional the amount that you remeasure based on that 30% that we have here. Okay. 7.4 here is from the investment by Y. Yeah? So you're going to have 7754. Okay, just finish with this one. Yeah. Okay, so and then you have here shares capital in Z. This one is for the NCI. NCI only have 46%. Okay, return profit also 45%. So the goodwill here is already calculated F1150. NCI in financial position is going to have 84.50. And then this one is a shares of profit. Share of profit in Z. So you're going to have 46% time with 2 million. So you're going to have debit NCI in comprehensive income and then credit NCI in a financial positions. Okay, this is the statement, a consolidated financial statement. So A, B, C, D, you just refer to the journal entry that we have here. So that is what we have here. Okay, and then the last thing, you prepare the statements, proper statements. The proper statement is come from the adjustments here. This is a proper statement. Shares capital, reserve, NCI, and then goodwill, and then sundries asset. So only this one, proper statements here. Okay. This previous one is only the adjustments. Make sure that you know how to prepare this one, the adjustments. Okay, and then we have 2 more minutes. Just finish with the subsidiary making loss. Okay, for subsidiary making loss here, you need to prepare a consolidated account, and then this consolidated account should recognize a loss. Full loss of subsidiary should be included. NCI in that subsidiary should be charged also in the share of loss. Let's say the subsidiary have a loss, so this loss going to allocate to parents and also to the NCI. Even though if this result in the NCI having a deficit balance, you still have to allocate the loss to the NCI even though the NCI has a debit balance. Account of loss-making subsidiary should be continued to consolidate until it's declared insolvent or it declared as a bankrupt. So you still need to prepare a consolidated financial statement even though your subsidiary have a loss until the subsidiary become insolvency. Okay. In a separate accounts of parent, the investment of subsidiary should be recorded at cost and then need to be written down to recognize the impairment loss. So the investments here need to minus the impairment loss. So we're going to have the new CA. The investment in the subsidiary should carry at a recoverable amount. So recoverable amount here is your new CE. In the consolidated statements of profit or loss, recognizing loss of subsidiary need an extra charge to write down or write off any remaining goodwill at the acquisitions of the subsidiary. So any impairment loss, you need to credit a goodwill. If you don't have, if you have a goodwill, if there is no goodwill, then we need to transfer this impairment loss to income statement. The first thing that we need to do here, we eliminate through goodwill first. Okay, debit impairment loss, credit a goodwill. If you're already done with the goodwill, so goodwill is already finished. After for the elimination of that loss, then the amount of impairment loss going to transfer to the income statement. When the loss-making subsidiary is placed under receivership or under the liquidation, the control of subsidiary will pass to the receivership, and then we need to exclude from consolidation. So once the subsidiary that making loss is under the process of liquidation, then we're going to exclude that subsidiary from a consolidated financial statement. So this is what you have here once they are in process of liquidation. Okay, so we are done with this topic, a bit rushing here. So the things that we need to do for the next class, I want you to prepare the answer. Please try to prepare the answer for the exercise, or not exercise, example that you have at the end of your notes here. For the example for Tuah, Kasturi and Jebat for that three companies. So we're going to discuss that example for maybe for the first half an hour, assuming that you already prepared the answer for that one. And then the rest, we're going to continue with a new chapter, chapter 4, which is a consolidated financial statement. Hopefully that by the end of next week, we settle with a cash flow statement, because there is about 40 slides only for the cash flow statement. Yeah? Because after your mid break, when you come back after your mid break on that 16, you need to submit tutorials on cash flow. So please, for the next class, prepare the answer for the examples. Okay, just try to prepare, and then we're going to look at that things together, the examples together. We're going to check your answers together. Okay, whether you understand or not. I think the example is simple. It's simple for this example on Tuah, Kasturi and Jebat. Yeah? So going to end the class now. If you have any question, I'll still be around. Due date for tutorial 3. Okay, we're going to extend the tutorial 3. Suppose that you need to submit your tutorial 3 by 2nd of May. So we're going to extend that one until 5th of May. Means that after we finish discuss your example, then you can submit your tutorials. So your tutorials here will be on, the submissions here will be 5th of May. Okay. Any other questions that you have? I'm still be around for those who have a questions here. Okay, the rest you may